Okay, in the previous class I have discussed about income method, and I have also gone through this part where I have discussed about how to reach a national income or how to reach NNP at factor cost from GDP at market price. In the previous class I have discussed about that how to reach NNP at factor cost from GDP at market price. If you haven't seen it, go to the macro playlist and watch that, then come to this lecture. It will be very easier for you in that case, otherwise it will be a little bit difficult. Now expenditure method, we basically, there are some components just like the previous income method. In the expenditure method also there are some components. One is final consumption expenditure. So second one is gross domestic capital formation, and third one is change in stock, not change in stock, third one is net export. And if you add these three components, if you add final consumption expenditure, and if you add gross domestic capital formation, and if you add net export, you will basically get the national income. Okay, so final consumption expenditure, in the final consumption expenditure there are basically two sub components. One is private or household final consumption expenditure, and another one is government final consumption expenditure. So we as household buy clothes, buy foods, buy different type of products, right? So whatever consumption expenditure is done by us as private household is basically private or household final consumption expenditure. Why is it final? Because we as household, in this part, in the name of this component or the name of this part is final consumption expenditure. So by the word final, we basically meant here that the consumption expenditure should be done on final goods. What is final good? That I have already discussed in the previous classes, that the goods that are ready for consumption and has completed all the stages of production, that good is basically the final good. Like whatever is ready to be consumed can be termed as final good, like bags, cloths, prepared cloths, completely prepared cloths, then laptop, computer, burger, all of these are basically final goods. But if I take an example of part of a card, or part of a bike, or chain which is a part of a bag, those are not ready for final consumption, so those are not final goods. Okay, so here whenever we are talking about final consumption expenditure, we are basically telling that the consumption expenditure should be made on final goods, only then it will be treated, or only then it will be included in this part A. So private or final consumption expenditure, private or household consumption expenditure done on the final goods, this is the sub component of the component A. And what is the second component or second sub component of the component A? Government final consumption expenditure, that is consumption expenditure done on final goods by the government. The government also does consumption expenditure, buys consumption goods, final goods. So whatever consumption expenditure done by the government on final goods comes under the part B or component sub component B of component A. Component B tells us about gross domestic capital formation. So gross domestic capital formation is also known as fixed investment, and it has two parts: business fixed investment, government fixed investment, and investment on residential household. So three parts actually. If any entrepreneur who is not the part of government making any investment into his business or into his farm or into his production process, buying new machines, hiring new laborers, buying new lands, whatever investment he is doing, okay, whatever investment a new or any entrepreneur who is not part of the government is doing is basically business fixed investment. If the investment is done by the government, if the government is making bridges, railways, roads, infrastructure, hospitals, nursing homes, then that investment will be treated as government fixed investment. And investment on residential construction by the household, me me, I am basically a part of a household. So suppose for my residential living, or just to be, I mean, just to live, I am making a house. I am making a house. So that house will be constructed, right? That residential construction, that means that construction of the house, whatever investment I am doing to construct my house, and obviously I will live in that house. Whatever investment I am doing for constructing the house is basically investment on residential construction by household, and that should also that is also a part of the gross fixed capital formation. That is also a part of the gross fixed capital formation, just like business fixed investment and government fixed investment. Now some of you might think that I am making this house for my personal use, for my personal consumption. So why is it added to the gross domestic fixed capital formation, or why is it even calculated in national income? I mean, the point is it should be calculated in national income, but why is it added in the part of investment? Because we know that if someone is consuming anything for their personal use, or if someone is buying any product for their personal use, then that is consumption, not investment. Here I am making the house for my personal consumption, so how can it be a part of investment? How can it be the part of component B? Well, the answer is, whenever I am making this investment on the residential construction by the household, whatever ingredients, whatever cement, or all the other things that I am buying are actually influencing the economic condition, are actually making the economy to move, because there are demand that is being created in the market. Why? Because for making this house, I am making for making this house, I have to buy cements, I have to buy multiple different things, and the demand for those products will rise in the market. That's why economic fluctuations will happen, and whenever economic fluctuations are happening, that can be treated as investment. That's why investment on residential construction by household is a part of the gross domestic fixed capital formation. So if I add this A plus B plus C, what will I get? I will get part I. Look for part I. Part I is basically gross domestic fixed capital formation. How to get this? A plus B plus C. And how to get the entire gross domestic capital formation? For that I have to add part A and part B. Now, no, not part A, not part B, sorry. For that I have to add uh, 1 plus 2. Now 1 is known to us, this is 1. Which one is 2? So let me clear which one is 2. Change in stock. I have to add this change in stock along with the part 1 to get this entire gross fixed capital formation. Change in stock is basically known as inventory investment, whatever investment that is done on the inventories, right? So basically delta S means change in stock, delta denotes change. Closing stock minus opening stock. So suppose I have opened the production process by um, 20 products, and this is on 1st April 2024, and when the financial year was coming to end uh, on the 31st March 2025, my stock is 180. There are total 180 products in my stock. So what is the change in stock? The change in stock is basically closing stock minus opening stock. Closing stock is 180, opening stock is 20, so that is 160 is my change in stock. As my stock started with 20 products but ended with 180, so there are total 160 amount of change in stock. Okay, so if you add this gross domestic fixed capital formation, that is part 1, with change in stock, that is also known as inventory investment. Then what will you get? You will get gross domestic, not domestic, sorry, gross fixed capital formation. Okay, let me just show you to you again. Here it is, gross domestic capital formation. How to get is gross domestic fixed capital formation. I might have written it a little bit wrong. Yes, this should be gross domestic capital formation. Capital formation is what? Gross domestic capital formation plus inventory investment, that is change in stock, gives us what? Gives us sorry, I am writing it a little bit wrong. Let me just rewrite it. I have confused it a little bit. Okay, so if I add part 2, which is the change in stock, with part 1, what is the part 1? The part 1 is basically gross domestic fixed investment. Okay, gross domestic fixed investment. Then I am getting the part A with part B. Then I am getting the part B. What is that part B? The name of this part B, as you can see from here also, it is gross domestic capital formation. Gross domestic capital formation. So if you add gross domestic fixed investment with change in stock, that is inventory investment, you will get gross domestic capital formation. That is the part B. And part C is net export. That is very simple. You have to add the amount of you have to take the amount of export and subtract the amount of import from it, and you will get net export. Now, as we have seen, the part A, part B and part C, you have to add it to get GDP at market price. And in the previous lecture I have detailedly explained that how to get NNP at factor cost from GDP at market price. So I hope you can easily do it now. There are some precautions. Only the final expenditure is to be taken into account, because if you take intermediate consumption also, then there can be a problem of double counting that can arise. That when a leather is purchased, that leather is not ready for consumption, it is not any final good. So the price of, or the value of leather, that is 200 rupees, I have taken into calculation. But again, when that leather was converted into a bag and the price of the bag is 500 rupees, within that 500 rupees, the cost of leather, that is 200, plus the cost of the laborer, that is wage, is 50 rupees, plus the cost of other materials, that is 250. All of those things were already there within the bag, right? But when I am adding these things, I am getting 700. But now you tell me that is it really 700? The valuation is not actually 700, because this 200, the price of the leather should be removed, right? So there can be a problem of double counting. Why? Because I am counting the valuation of leather twice. How? The value of leather is already counted here once. Again, within the price of the bag, that is 500 rupees, this value of leather 200 rupees is again counted. So in this way the problem of double counting arises. So we have to take care of that. Expenditure of second hand goods is not included in GDP. That is another precaution that we have to take care of. Expenditure on shares, bonds are not included in the expenditure. Expenditure on transfer payment, whatever transfer payments, subsidies, that transfer payment, in a way we can say that scholarships can be treated as transfer payment. What is basically transfer payment? When government is making any payment and in return government is not expecting anything, I mean the government is not bounded to expect anything in return of that payment, then we call it a transfer payment. Pension can be an example of transfer payment, because that person is not going to give anything to the government. In his prime time when he was working, he was giving productivity to the government, but now he is retired and he is getting pension, but he is not going to give anything now to the government, right? So transfer payment is basically a type of payment from which government uh, I mean from which government doesn't expect anything back. Whoever government, transfer payment is given to, suppose, part A, part B, part C, people A, person B, person C. The government is giving transfer payment to all of them pay. Okay, so government is giving the transfer payment to all these three persons. Now government can't expect anything back from these people. This is the motto of transfer payment. Okay, so expenditure done on the transfer payment should not be included in the calculation of GDP. Imputed value of self consumption, I have already discussed about it in the previous class, that if someone is um, producing anything for his self consumption, I am cultivating, suppose, wheat, or I am cultivating jowar or bajra or ragi, and I am going to consume it by myself or by my family. In that case, that will not be treated as a part of GDP. A numerical is given here: gross investment given, net export given, net indirect tax given, depreciation given, NFIA given, private consumption expenditure given, and government purchase of goods and services given. So as you already know that we have to find for the part A and part B and part C. Now in part A, what was basically there? In part A, we know that there were basically what was part A? Try to remember with me that whenever we have studied about the part A, it was basically the final consumption expenditure. That has two parts: government final consumption expenditure and personal or private final consumption expenditure. So as you can see from here, this private consumption expenditure is given here 350, and government purchase of goods and service means what? It means government final consumption expenditure, it is 100. So if I add these two things, what is being obtained? We are obtaining part A, which is 450. Now look for part B. Part B contains which component? Gross investment, right? This was basically the section A of part B. Let me show you. Section A of part B has several subcomponents, right? As we have seen, no, not section A, sorry. From part B, we had these things: gross domestic capital formation. This is directly given here. In the question. So we don't have to make these calculations. To find out that part B. That part B is directly given here in the question. If in any question it is not directly given, in that case we have to calculate. By following the steps and following the formulas. But here this is directly given. This is directly our part B. And which one is the part C? The part C is nothing but the net export. So now you can easily calculate the part A plus part B plus part C, and you will get what? You will get GDP at market price. And from GDP at market price, how to reach NNP at factor cost? I am not going to explain it anymore, because I have already discussed it in a very detailed and minute way in my previous lecture. So go through that and you can get the answer here also. It is done here. Okay, so you can go through from this portion also. Okay, in the next class we are going to discuss about the value addition method.